Hi, everybody. Good morning. Now that John's put the pressure on that this isn't supposed to be dull, bear with me because I haven't done one of these in 3 years. As a matter of fact, the last one I did was for John in April in Chicago in 2012. So it might take me a while to get going. So hopefully it won't be dull. But anyway, I think the way I want to start out is by answering a question that a lot of you guys, not a lot, the few people that I've talked to yesterday and a few people I talked to last night were asking me that I'm writing a third book. And I guess I should ask you first, have a lot of you read Trading in the Zone or The Disciplined Trader? And so you're probably wondering, well, why am I writing a third book, right? Would that something come to your mind? Yeah. Okay, like why am I doing that? Well, okay, here's the reason why I'm doing it. About 8 years ago, I was asked to speak at a trading conference that was going to be quite large. Be about 5,000 or 6,000 people were expected to attend the conference. It was going to be in Texas, and if you people have been in this business for a while, you'll know that there's a lot of people that just aren't that ethical. I mean, there's a lot of ways that people can be taken advantage of in this business, and there's a lot of people that understand that, a lot of people that exploit people who want to become traders. And so as a result, I didn't want to be associated with somebody or an organization that fell into that category. And I asked them to, and I knew they had user groups all over the country, and so I asked them if I could attend some of their user group meetings to see just how well they lived up to their claims of customer service and the kind of products that they offered. And so they had a pretty substantial user group in the Phoenix area, and I attended. There were probably a little over 100 people, maybe 110, 20 people, and I was just kind of taken back. One, I mean, everyone was really enthused with this company. They really loved the product. They loved the customer service that they were providing. And but the other thing I was taken back by was just how absolutely, totally clueless they were. And because I was used to working. I started coaching in really around 1982 or 1983, and most of the people that I worked with were like floor traders, at the Chicago Board of Trade, Chicago Mercantile Exchange, and then later on a lot of hedge fund managers, and people who fell into the category of what I call professional traders. I mean, people who are diehard traders. And so actually my coaching clientele kind of fell into two categories with nobody in between. In that I had the professionals, people who had been in the business for a long time, and they understood just based on their experience the importance of their state of mind and their psychology played on their results. So there wasn't any convincing them, that this was the direction they needed to go. And then at the other end of the extreme was the person who had been in the business for probably quite a while, lost usually a lot of money, lost their account several times, and they're at the point of what I call total and complete exasperation, where you might want to think of someone being on an alcoholic bender, and they wake up with their head in the gutter, literally their head in the gutter, and they look up and they say, okay, God, I'm ready, I'll do anything. And they mean it. It's not lip service, it's not bullshit, they really mean it. I'll do anything. And so I didn't have anybody in between because they didn't realize what they were getting into. Okay? So basically, this group of people in the user group, they were all these in-betweeners. And not only they were just in-betweeners, none of them were professionals. They were like, just really what I call nice people. But I mean, not that professional traders can't be nice people, but they're a breed apart. They really are. They're I'm not going to get into that, but in any case, they're different. But so I'm thinking, you know what? I have to write a book for these people. I just, because the Disciplined Trader and Trading in the Zone did not really address the issues in a way that someone just starting out in the business could relate to. I made a lot of assumptions writing those books. Made a lot of assumptions based on my experiences of doing these kind of presentations and speaking at trading conferences back in the, in the early 80s. Like the first conference I spoke at was in 1984. And I spoke at, several years later. I even went on a world tour for Dow Jones in 1987. I literally went around the world for Dow Jones and Reuters. Out of a 36 city tour, I could have done all 36 cities. I didn't want to be gone that long, but I did 18 out of 36 cities and went all the way around the world. So it's like I have this basic experience of the way people think about trading, but yet, like I said, I didn't write these books in a way that the novice trader could relate to. And it shocked me, literally shocked me, because The Disciplined Trader was published in 1990, and Trading in the Zone was published in 2000. And when the internet started getting big, and you had a lot of people doing chat rooms and all this sort of stuff, and people were recommending, that, hey, read Trading in the Zone, and a lot of the people that were reading it were just novice traders, because I'm getting this feedback and emails. It's like, whoa, this book wasn't meant for you. And I didn't even really know how you were relating to it. So I thought, you know what, I got to write another book, and I got to write it from the perspective, and I got to write it from the perspective of someone who really doesn't know anything about this business. The people in that room in Phoenix were people who basically had watched like a half-an-hour infomercial on how you can take financial control of your life by being a trader. Okay, secure your retirement, go into trading. Okay, with this particular methodology, and you should be able to do it. Well, the reality of it is, a lot of these methodologies, people aren't lying to you about the fact that if you can actually follow the methodology, you can secure your financial future. The whole idea is being able to do it. Just like, for example, the very first workshop that I ever attended was in Bermuda, like I think in 1981, and at the time it was being put on by at that time, people who were considered market gurus. And, and at the very first morning of the conference, I mean, I'm really excited, what am I going to learn? Oh, I just can't wait. And I sit down in the room, and the speaker, he gets going, and he's going for about 10 minutes. And someone in the audience raises their hand, and he stood up, and Jake, the speaker's name was Jake, and he stood up. As a matter of fact, it was Jake Bernstein. He's written a lot of books. You probably heard of him. Anyway, so Jake acknowledged the guy in the audience, and the guy stood up, and he said, and the speakers, of course, were going to talk about their trading systems and how people use them, that sort of thing. And the guy stood up, and he, in kind of an indignant tone that really surprised me, and I think it also surprised Jake. He said, "Jake, your system's so good, why are you selling it?" And, I think the whole thing kind of took Jake by surprise, like I said. And Jake just stood there and thought for a second. And he said, "You know what? I'll sell as many of them as you want to buy. Because out of all the 100 or so people in this room, there probably isn't one of you that could go back and execute it." Now, I'm sitting there listening to this, and I think, he didn't say this in a way that I thought he was kidding. So, I'm thinking, well, what's going on here? And nobody asked him to elaborate. So it's like, I'm just hoping this didn't apply to me. Okay, I'm just like, I don't know what he's saying. I don't know why he's saying it. I just hope it isn't me he's talking about. Okay, and it was, of course, it was definitely me, as well as everyone else in the room. So anyway, like I said, I really felt I had to write something from ground zero. In other words, if you don't know anything about this business, if you don't know anything about the nature of trading, and especially if you don't know anything about the nature of price movement, that you can actually go through, understand what you need to go through, and go through a process of changing the way that you think, because this is what this is all about, everybody. You're going to have to get used to the idea that if you're going to do this successfully, you are probably going to have to change some major assumptions, some major beliefs that you have about the nature of market trading to do it successfully. I'm not saying you're not going to have winning trades. I'm saying that if you want to create a consistently rising equity curve and assure yourself of an income, you're going to have to think differently than what you think right now. There's no way around it. Like, for example, most of you in this room, just quick example, most of you in this room would think that because I'm a trader and because I put on trades, I'm a risk taker. Does that make sense? Because we know that trading is risky, right? Come on, I'm going to have to get some feedback, guys, okay? You can't sit there stone-faced. You really can't. Seriously, you can, but it's going to make things hard for me. I don't want it to be hard for me. I want to enjoy myself, okay? So come on, just give me some feedback. Yes or no?
Yes.
Okay, thank you. Remember, I haven't done this in 3 years, so give me a break. I'm asking you nice. So, yeah, we're risk takers, right? And yet, when you think about it, everything that you do, or let's say I used to do as a trader with respect to analysis, was to try to eliminate the risk. Was to try to make the risk go away. Was to try to make sure that the trade I'm getting into right now, this trade, was going to be a winner. Not maybe a winner, but going to be a winner. Or why would I do it? Why would I get into a trade if I didn't think it was going to win? Does that make sense to everybody? Is that the kind of logic that makes sense? That's exactly the kind of logic that's going to make sure you're not going to be successful in this business. It's exactly the kind of logic that is going to assure you that you will not make it in this business. This business has nothing to do with winning on a trade-by-trade basis. On a trade-by-trade basis. What you're going to learn today is that your technical systems, okay, what they give you is an edge. Everyone, you heard the word probability said 100 times. Probabilities, edges. Edge is nothing more than a higher probability of one thing happening over another. There's a huge difference between understanding that concept and actually believing it in a way that you can execute your trades properly. You actually have to believe in the nature of probabilities at the very core of your trading personality. Which means you're going to have to give up on the idea that each individual trade is going to be successful. What your system does is give you an edge over a series of trades. where the outcome of each individual trade is unknown and unknowable. Not just unknown, unknowable. The more you think you got to know in this business, the less successful you're going to be. This isn't a business about knowing what's going to happen next. It's a business of getting your mind to the point where you're completely detached from your outcomes. Very different than the way we live our lives. Gino, I was talking to Gino last night. Gino's been an attorney for how many years? 43 years. What did you learn when you became a trader in relationship to the kind of strategies that you used as a trader?
Everything I use in law absolutely is completely the opposite in trade.
Did you hear what he said? Everything he used to be a successful lawyer is completely opposite of the strategies and the thinking methodologies that we have to use to be traders. If I'm a lawyer, am I detached from my outcome?
Yeah.
You are? Yeah. If I'm a lawyer, am I detached from my outcome? Oh, no. If I'm a lawyer, am I detached from my outcome? Absolutely not. I'm going to make sure that I get the outcome I want. If I'm a doctor, am I detached from my outcome? If I'm an engineer, am I detached from my outcome? So if I'm saying to you to be successful in this business, you're going to have to become detached from your outcomes. Just how in the world are you going to get to the point where you can do that? You don't know. You're right. You probably don't. Thank you. Trade for somebody else. Not everybody. You know, the groups falling. There are people that can trade for somebody else and be detached, and trade for somebody else, and actually they're even more attached than what they would be normally. I work with both ways. There are people who can actually trade their own money. Once they learn the right methodology and the right mindset, they can trade their own money much easier than they can trade somebody else's, because they're more concerned about, losing money for other people. Somebody you don't know? Yeah, it's still. There's a lot of variables in there. Yeah, that's, So basically, I had to write this book from, like I said, from the perspective of going from the ground up. And having 2 books under my belt, which I thought were really tough books to write. I mean, they were very, very difficult books for me to write. And I'm thinking, and this is my own bias that I'm going into this whole project with. Like, okay, I wrote the Disciplined Trader. It took me 8 years. I wrote Trading in the Zone. It took me 5 years. Come on, I should be able to knock this out in a couple of years, right? Anybody, right? Should be able to knock this out in a couple of years? Yeah. 8 years and I'm still not done. Way harder than Trading in the Zone. Way over the top harder than Trading in the Zone or the Disciplined Trader. I can't even begin to tell you how difficult it's been and how challenging it's been for me, and how just the impact that it's had on my life. Even it's just really been very, very difficult. But in any case, I found that breaking these concepts down to a core level where someone who doesn't know the business can understand it was not easy. And I made a lot, over the years, doing presentations, I've made a lot of assumptions. See, it's one thing to know how to trade, to break through the certain what I call the threshold of consistency. Like if over here, this is like a mental threshold, okay? Like if you're down here and you're booming and busting, okay, your equity is, you go up, you go down, you go up, you go down, and you want an equity curve that looks like this, you're going to have to break through what I call the threshold of consistency. And this is a mindset. It has nothing to do with your methodology. I'd say nothing. But you're going to have a good edge. All I'm saying is that, but there are a lot of good edges out there, okay? But so this is a mindset. Breaking these concepts down in that way was just, I made a lot of assumptions. And breaking through my own assumptions was really a difficult process. Because what I was getting at is that it's one thing to learn how to trade for yourself. And however way you manage to break through this threshold of consistency, it's another to actually learn how to teach people how to do it. The process of doing it and teaching people how to do it are worlds apart. There's almost no connection. There's almost no connection at all. Because there are a lot of people who teach trading because they become successful traders, legitimately successful traders, and they teach it from their perspective without realizing that their audience is nowhere near their mindset and cannot do what they do. When I was, coaching in the early, the mid 80s to early 90s, I'm not going to mention names, but there were some, trading gurus out there that had huge followings, and brilliant people, very successful traders, but absolutely did not know how to teach it, did not know how to understand, where the common guy was coming from, and most of like my really serious suicidal clients were as a result of listening to these people. The ones that ended up, waking up in the gutter saying, "Oh my God, I'll do anything." Just because they didn't know how to teach it, that's all. And because the process of learning how to teach it is completely different than the process of learning how to do it. So like I said, I made assumptions. And those assumptions resulted in, making it really difficult for people reading The Disciplined Trader and Trading in the Zone to get what they needed out of it to break through this threshold of consistency. And I didn't really know that until, I got almost to the end of the book where, it's like the exercise in Trading in the Zone. When I finished that book in like 1999, it's like I thought I explained it. I really did. I thought I explained it. I'm going to apologize to you now, realizing that I didn't. I really didn't explain it, because in this new book, I've devoted 30 single-space typewritten pages to just the exercise. Because the big assumption that I made was that all the background, all the material that I wrote to as foundation to do the exercise, that somehow people would find a way to assimilate it and realize the connection on their own. And then when I started actually getting to the point where I had to write about the exercise, I realized that wasn't going to happen. And the reason why I know it didn't happen is because I would do presentations, and like for example in 2008, 2009, 2010, whatever, and because I did several for John in a row, where I did, like I said, 8, 9, 10, 11, and 12. Last one was in 2012. And so like in 2010, I go through the whole presentation, and explain what I felt people needed to get, and the exercise itself, but pretty much explained it within the context of Trading in the Zone. And then the next year, some people would, a lot of the same people, there's 100 people in the room, but there's a percentage of them that were there the year before. And I was like, how many of you did the exercise? Nobody. And not only that, I was wondering, okay, everyone in the audience pretty much, let's say the large percentage of people in the audience had read Trading in the Zone. And right off the bat, I'd say, okay, you've read Trading in the Zone. A lot of people said they'd read it multiple times. So I'm thinking, okay, how many did the exercise? Nobody. And it's like, so in 2011, we're going through this whole, and this mystified me. Now, I was truly perplexed. I really was. I did not get it. I really didn't get it. And so in 2011, somebody in the audience just happened to say, after closing, getting to the point where the presentation is completed, there as much time as we had, and someone said, well, how many of us do you think are going to do the exercise? And I said, nobody. They were all taken back by that, because I was just flat out, none of you are going to do it. And then the next year in 2012, there were a few people that actually did it, and they got the results that they were looking for. Now, we're going to talk about this, and we're going to talk about it in great length, mostly tomorrow, but it's like, I want you to leave understanding the process, understanding what it is that you have to do, and the process that you're going to have to go through to get to the point where you can acquire the kind of psychological skills, because all the skills, there isn't anything about trading that's physical. What are you interacting with? You're interacting with information. There isn't anything physical other than just, if you've got the ability to use your mouse pad or use a mouse, you've got the eye-hand coordination to put your mouse in a certain spot on your trading platform, you got the skills down pat. You're golden on the skills, the physical skills. It's mental skills. It's how we interact with information, the state of mind that we're in. People don't realize that, that this is like to really do trading at a really high level, in what I call the subjective or the discretionary mode, as opposed to mechanical trading, where you've got a particular set of criteria that define your entry and exit, and it's rigid. So the market has to conform. The market has to conform to your rules, or you do nothing. Okay, I'm just going to give you a cursory explanation. In the mechanical mode, the market has to conform to your entry and exit rules, or you do nothing. There's nothing to do. There's nothing to think about. You're just supposed to do, enter when it says, put your stop where it says, put your objective where it says, and it either happens or it doesn't. Okay? In the subjective mode, basically discretionary mode, you can do whatever you want, whenever you want, based on whatever information you expose yourself to, and the way you want to combine that information in your brain to come up with an entry or exit signal, and where to put your stop and where to put your profit objective. To be in that mode and do it successfully, you better be in a real elevated state of mind. Because what you're going to find is that it's your attitude, it's a quality of your state of mind. Like, are you confident? Are you fearful? Are you in a carefree state of mind? Are you agitated? Are you angry? You feel like, do you feel like getting revenge? If you're going through personal emotional trauma, if someone said, if someone you knew was trading, was a full-time trader, and they're going through a real traumatic experience in their life, would you advise them not to trade? Makes sense, right? Just makes sense. And yet what people don't realize is that there are degrees of states of mind. In other words, you've got on a continuum. At one end you've got you've got positive, you've got confidence, okay, you got confidence, and here you got fear. And there are degrees of confidence and fear. And until you become aware of where you're at on that continuum, you have to adjust the way you trade based on your awareness of where your state of mind is. Because your results are going to reflect that. The way you pick, what information you pick or you choose to utilize, and where your trade location, your size, your stop, your objective, all going to be reflected in your state of mind. It would be. I'll give you an example. We had just had the NCAA, college basketball championship, right? Okay. Now if I said that at a professional or even a college level that some of these kids or some of these guys, they can hit 25 or 50 free throws in a row, would anybody dispute that? That they can practice, they practice thousands of shots, and they get at the free throw line while they're in practice and hit 25 in a row, 30 in a row. There are people who can do that. So if you can do that, you have got your muscle memory in place. Your muscles are chained to the foot, like as if you're like there's these little memory cells in each of our muscles. It's like they're completely in place so that you know that when you step, all the physical variables are exactly the same, no matter where you're doing it. The foul line is right here. The basket's so many feet away. The basket's a certain height. The rim is a certain diameter. That's it. All the variables are the same. Now, put one of these kids who can do 25 in a row in a situation where there's about 2 seconds left in the game, the national championship's on the line, and with 2 shots, he can win the game. With 1 shot, he can tie. 2 shots, he can win the game for himself, his college, all the fans, and his team. 1 shot, he ties. What is going to be the determining factor as to whether or not he wins that game? Well, when you say control that fear, you might not have any fear. All I'm saying, what's going to be, just at a general level, what's going to be the determining factor? What? Mental, his state of mind. Yeah, his state of mind. Why do you think, everyone knows, like for example, field goal kickers who are in a position where they can kick a field goal and win the game, the opposing coach calls a timeout. They put them on ice. Okay, everyone knows. But what does putting them on ice mean? It means, you know what? These guys are pros. You give them the opportunity to get up to that tee and kick the ball without thinking. Their muscle memory is going to come into play, and it's going to be automatic. Now give the guy the opportunity to start rolling some negative thoughts through his brain, and he might choke. Same thing with the kid on the foul line. If he can keep his thoughts positively focused on the process of doing what he needs to do, he'll probably make both shots. If he starts thinking how his life's going to go to shit, complete and absolute shit, if he misses those shots, chances are he's going to miss them. If some thoughts start rolling through his brain about coaches who have berated him, parents who have berated him throughout his life, and being in these kinds of situations, chances are he's going to miss those shots and choke. And this will go right along here. Here we had just normal confidence, and there's what's called a threshold of euphoria. Okay? You can cross from normal confidence into a threshold of euphoria, which is just as bad as being in a state of fear for a trader. But same way with this kid. Let's say he's standing at the foul line, and he's starting to think about what a hero he's going to be in a couple of seconds. And he starts celebrating in his brain before he actually takes the shots. That extra degree of excitement just might have enough of an impact on the way the ball leaves his fingers for him to miss the shots. So it can't be too much. It can't be fearful. He just has to have the right amount of confidence flowing through his brain and the right amount, and be focused in just the right way before the ball leaves his fingers. And he'll make the shot because the muscle memory is there. Anybody have a problem with this? When we're trading in the discretionary mode, these are the things we've got to be aware of. We're interacting with information. It's like the analogy would be the kid's muscle memory to shoot the free throw would be our memory of all the different patterns we've learned about how to define an edge. The patterns are in our brain. We can identify them when we see them in the market. How we utilize those patterns are going to be a function of the state of mind that we're in. Now, you don't have to get to that level of awareness to be a successful trader if you stay in the mechanical mode. In other words, once you learn how to identify an edge, you learn how to think in probabilities, you get rid of what I'm going to just refer to as the 4 primary trading fears: the fear of being wrong, the fear of losing money, the fear of missing out, the fear of leaving money on the table. When you've neutralized those 4 fears and you can trade in a carefree state of mind, carefree, detached state of mind, you can stay in the mechanical mode for your whole trading career. And don't really have to address a lot of these state of mind issues. Not that they won't come into play, Not that they won't come into play, because they will. If they're there, they will. But at least in the mechanical mode, you know exactly what you need to do and when you need to do it. So any thought of deviating from that, you know there's a problem. We'll get. I'm going to get some perplexed look on it. I'm not going into detail. I'm just giving you an overview here, okay? So don't get too perplexed. Go ahead. Oh yeah, the fear of being wrong, the fear of losing, missing out, leaving money on the table. So you don't have to reach that level of awareness, that, let's say, heightened level of awareness to be able to be successful. But you better be at that heightened level of awareness if you don't want to create disastrous results in the subjective mode. Most people are trading outside their skill level, meaning they should be trading mechanically, and they're trading subjectively. They're trading in the discretionary mode, and they have nowhere near the skills to be able to do it. Because in that mode, you can do whatever you want. See, in the mechanical mode, I would say you wouldn't even to think about pulling a stop, even to think about moving a stop is a trading error. In the subjective discretionary mode, you want to move a stop, move it. You want to pull a stop, pull it. Because the assumption is you're not doing it from a state of fear. You're not doing it because of what you're afraid of the results are. You're doing it because that's what the market's telling you to do in this moment, based on your ability to read the market from an objective perspective. Because every mistake, just about every mistake that you can make as a trader, will be the result of, I'm afraid of being wrong, I'm afraid of losing money, I'm afraid of missing out, I'm afraid of leaving money on the table. You're going to get in too soon, you're going to get in too late, you're not going to define your risk because you're thinking, hey, why define the risk? I know we can get in this trade if I think it's going to be a winner, so there is no risk. Yeah, oh, okay, yeah. Or you say, you read all the books and you go to the conferences and say, hey, don't do this without determining what your risk is before you get into a trade. And so you think, okay, well, I've got to, everyone says I got to do it, so I'll do it. So basically, it's lip service. Lip service in the sense that, okay, you'll put a stop in the market, and that's where usually people use percentage stops as opposed to what I call structure stops. Structure stops are where you're actually reading the market in a way where, where's the best place from a structure perspective that tells you this trade isn't working, or the likelihood of it working is so diminished in relationship to the profit objective it's not worth staying in anymore. Did you guys get what I just said? Okay, that's a structure stop. When you pick an arbitrary percentage stop like 1 or 2%, that's people that do that usually that's risk. That's lip service risk management. They really don't believe they're going to get stopped out, but they've been told over and over again you got to do something like that, and so they put their percentage stop in the market and thinking, well, it's never going to get hit anyway. And of course, when it starts to look like it's going to get hit, they'll either pull it and put it somewhere else, or if they're coming out of a state of basically pain where they've lost 3 or 4 trades in a row, if it starts even getting close, they'll pull it thinking, I'm going to save myself some money. Nobody in this room done that? Oh, okay. Yeah. Today, yeah, right. It could be anything, yes. A structure stop could be, the question is the structure stop like a 2-bar stop? Well, a structure stop is based on your definition of an edge. We have edges for getting in, we have edges for getting out. Whether the edge is defined as a profit objective or a place where the market's telling us that the likelihood of this trade not working is so great it's not worth spending any more money on. Or not worth, in other words, the likelihood of it even hitting the profit objective is so diminished that it's not worth spending any more money on. Go ahead. No, not in this business. Zero fear. Absolutely zero fear. Absolutely zero fear. I want to be emphatic about that. No, there is no, absolutely zero fear. You have got to trust, this is a good question, thank you very much. You have got to trust yourself, because what you're going to find when I get into this example is that fear acts on our perception of information in a way that we actually create the very experience we're trying to avoid. Okay, I'm going to explain how that works. But fear will act on our perception of information, how we perceive it, the way we filter the information, and how we behave in a way where we will actually create the very experience we're trying to avoid. So if I'm trying to avoid being wrong, that's exactly what I'm going to end up doing. I'm going to act and see things in a way that create a situation where I end up being wrong. If I'm afraid of losing money, that's exactly what I'm going to create for myself. Zero fear. Not only that, you have to, because fear and trust are opposite of each other. You've got to be able to trust yourself. You have to be able to completely and absolutely trust yourself that you can act in your own best interest and do the right thing without experiencing pain first. How can you be successful in this business if you have to experience pain to get out of a losing trade? That if it takes that much, in other words, the market has to go so far against us that we can't stand it anymore, that we eventually get out. Go ahead. No anxiety, no fear, no, completely carefree state of mind. You're going to have to get to the point where you're in a completely objective, carefree state of mind. You cannot care about the outcome. Remember, it wasn't even that long ago. It's detached from the outcome. You got to get your expectations in line with the reality of the environment you are operating in. You are operating in a probabilistic environment. That really means, not lip service, that really means probabilistic. Maybe I'm going to get the outcome that my edge says or my edge is predicting will happen. Maybe. I'm going to prove this to you. He said, one of the reasons why I wrote this third book is because I came to the realization that my personal experiences as a trader, starting out, I started trading in 1978. So my personal experience as a trader, and then going to work for Merrill Lynch at the Chicago Board of Trade as a retail broker, it's like I ended up learning things about how the market works that ordinarily, without being on the inside of the industry, people just wouldn't get. So I also took that for granted. And what people don't get is when they don't understand order flow, when they don't really understand the nature of order flow and how prices move from an order flow perspective, it's very hard to learn how to think. It'd be very hard to, let's say, extrapolate what, watching prices move on a screen in a way where you could think, well, I need to think like this, I need to think like this. So when you don't understand order flow, that really screws you up. Because when you really do, everything that I'm saying will become self-evident. When you understand order flow, all the things that I'm saying will just yeah, okay, yeah, that makes sense. So if I say to you that if you operate, you've got to get your expectations in line with the reality of the environment that you're operating in, it means you don't know what your outcomes are going to be. There's no way you can know what your outcomes are going to be. I'm also going to say that you don't also know why you're winning or losing. When you understand order flow, you will know that there is no way that you can know why you're winning or losing or even find out. Think about that one for a second. You don't know why you're winning or losing, and there's no way to find out. You understand how prices move to the extent where you can think to yourself, yeah, okay, that makes sense to me. I'm going to explain it to you, but does it make sense now? And the implications of what I just said is that every prediction your methodology makes, in essence, is a guess. And if it's a guess, the implications are, guess what? You're gambling. What's that? If you're guessing, you're gambling. That is the reality of our situation. We have no assured outcomes, and we cannot make a connection between the reasons why we put on a trade and the reasons why the market went in our favor or went against us. If we can't make that connection, then we don't know why we're winning or losing, and it isn't any different than sitting down at a blackjack table or playing a slot machine, because there's no way to know. We are gambling. Regardless of the fact that you're using analysis, regardless of how good your analysis is, I don't care how sophisticated it is, there is no analysis that can take the gambling element out of trading. Listen to me. There is no analysis that can take the gambling element out of trading. There is no analysis that can eliminate the risk. There is no analysis that can assure us that this trade is going to be a winner. When you understand order flow, you will agree with what I'm saying. And then you'll start thinking about this whole thing differently. So instead of trying to avoid the risk, instead of trying to use your analysis to avoid the unavoidable, to do the impossible, you will accept the risk and understand it from a probabilistic perspective, and then everything will change. Everything will change. You'll even see a different market. You'll see the same bars, but you'll be interpreting it in a way where it's like, oh yeah, okay, that makes sense. Yeah. It's like, one second. It's like, we're here in Las Vegas. How to casino? You heard John say, or somebody, maybe yesterday, or I think somebody said, about even trading in zone. It's like, like be the casino. Well, here's what this means. Like, casinos know that they have the law of probabilities working in their favor. The law of probabilities is like magic. See, the casinos really aren't gambling. Because they are gambling in one sense and gambling from one perspective, but not in another. On an event-by-event basis, this blackjack hand, this blackjack hand, this blackjack, every individual hand that's dealt, they don't know the outcome to, and in essence, they are gambling on the outcome of each individual hand. But since they have the law of probabilities working in their favor, what that means is that over a large series of events, they will always come out net winners. So in essence, they're not gambling. We can do the same thing as traders. Exact same thing. We have an edge. Our edge gives us a higher probability of one thing happening over another over a series of trades. But each individual trade, the outcome is not known nor knowable. All I have to do is execute that edge flawlessly every time, and I will come out a net winner. And in essence, over a series of trades, I'm not gambling. On each individual trade, I am. Are you guys with me on this? I'll explain it in more detail later on. There is nothing you can do to take away the risk. Burn that in your brain. There's nothing you can do to take away the risk. Any effort that you put towards taking away the risk is going to assure you of failing. To whatever degree you're going to try to take away the risk of being wrong, the risk of losing money, the risk of leaving money on the table, the risk of missing out, all these four fears will detract from your ability to create a consistently rising equity curve and cause you to make mistakes. Okay, go ahead. Who had a question back there? Go ahead. Well, I don't know how you define a good poker player. I'd have to know how you define I don't know how you define a good poker player, so it'd be hard for me to answer that question. What's that? Well, yeah. See, winning one night, or and getting on a winning streak is different than someone who can gamble and make a consistent income. People who can make consistent income gambling, work basically off the same kind of mindset. And they also there's a lot of other variables involved. It's like people who are immersed in gambling. I mean, there's a lot of dynamics in play that are not so much different from a psychological perspective. But for example, if and I don't gamble. I mean, I don't play blackjack anymore or anything else like that. But anyway, it's like if I were, what I would do, the first thing I would do is I'd walk through a casino and I try to find a dealer who's having a bad night. In other words, a dealer who's busting on a consistent basis. Or if I was playing craps, I would peruse the table until I found somebody who was hot with the dice. Because I do believe in streaks. I believe in winning and losing streaks. And if you can, and if I'm playing my cards right, if I've got a basic strategy on how I'm going to play my cards, or how I'm going to bet at craps, what I'm going to want to do is I'm going to want to, find somebody who's already on a streak or looks like they're going to be on a streak. In what way? If we flip the coin 1,000 times in a row, okay, we would come up with a pattern, a discernible pattern where there would be very little difference between heads and tails if the coin is evenly weighted. Right? This is the pattern that would come up over and over and over again. You could actually bet on it. You could actually bet on the fact that if I flip the coin enough times, like a thousand flips, that the relationship between heads and tails would be within 1%. Right? Let's see. But within that 1,000 flip sequence, can you have winning? You could have heads. Could heads come up 10 times in a row?
Yes.
Yeah. Okay. I didn't say it was predictive. What I'm saying is I'm just looking for people. I'm looking for situations where it's likely that this is if someone's on a winning streak, they're on a winning streak. I don't know how long it's going to last. Or why? I don't care. I'm just looking for edges. That's all I'm saying. So to answer his question about gambling, it's not a good correlation because there's too many other factors involved. So, but otherwise, I'm just looking for that kind of edge. Go ahead. Yeah, I will now, but the whole rest of the time is going to be pretty much elaborating on it. When I say be comfortable, you say be comfortable. I say that you accept the risk at such a core level of your trading personality, of your trading belief system, that there is no other part of your mental environment that would argue for anything different. In other words, what I mean is that when you've accepted that I could put this trade on, I do not know what the outcome is going to be. I don't care what the outcome is going to be because I've adopted a series of trades perspective, meaning that I don't know. What am I expecting? I'm expecting wins and losses over a series of trades, and I don't know the sequence of wins and losses. But I do know that my edge in the past has produced, let's say, a 60% win-loss ratio or a 70% win-loss ratio. Again, I don't know what the sequence to wins and losses are, and I don't care. I just need to execute properly. And when I get to the point where I really have accepted these principles, accepted them at the very core of my being, I will be able to do this without fear. I'm going to show you how to do it tomorrow. But what I'm saying is that this is where we're getting to. We're getting to the point where if you're going to do this right, you gotta transcend your fears. And to transcend your fears, you're going to have to learn how to think differently. It's that simple. If you're not willing to learn how to think differently, you might as well walk out of the room now. It's not going to happen for you. It really isn't. Go ahead. And there's enough back case of people who have been in this business for years, who have lost one or more fortunes, until they get to the point where they come to the realization that, you know what, my life strategies don't work in this business. Why do you think there's this theme in all really good traders, this theme that most of them had lost one or more fortunes before they finally broke through the threshold of being able to create consistent results? Because that's what it took. It took losing all that money to break down the resistance of their dysfunctional beliefs about the nature of this business or their erroneous assumptions about what this is about. And most of those erroneous assumptions have to do with analysis, which is normal, because when you think about the way we define analysis in our normal everyday life, if I step into and engage in an analytical process, and I really believe that process has validity, then when I come to a conclusion, I should think that I'm going to get the outcome I expect. Wrong in trading. That's not the case. You don't open up a trading account at a brokerage firm and they tell you that, you know what, whatever you think, the way you define analysis doesn't work here. Does not work. You're only using analysis to get an edge. And an edge is a higher probability of one thing happening over another. And if there's no way to assure myself that this trade I'm going to get into is a winner, I'm guessing. And if I'm guessing, I'm gambling. They tell you that? Anybody ever tell you that?
John told
Yeah. Okay. John's a good guy. Okay. I'm sorry. Yeah.
So go ahead and get involved in contract or something because of the pace of all the things, but it reduces your risk. That's part of your strategy. You're not eliminating risk.
No, you're not. No. You're never eliminating the risk.
Right.
You're accepting it. You're never eliminating it. There's nothing. Just you have to get to the point where you're just. And like I said, there's no question in your mind that the risk always exists. Now, when you say eliminating the risk by scaling out a yeah. Well, but see, there's a difference between what you say is reducing risk from a money management perspective and actually accepting the risk. When you reduce risk from a money management perspective, it's because the market's telling you, one, that's your strategy, okay, and two, the market's saying this is a good place to take some profits. That has nothing to do, I mean, you can say, the vernacular is, you can say, yes, I'm reducing risk, but that's not what I'm talking about. I'm talking about from a psychological perspective, actually accepting the risk, okay? So yeah, there's a difference, but these are subtle differences, and these are the kind of thing that gets us in trouble. See, when we don't understand these subtleties, we can get into a lot of trouble. Go ahead. Do I what? No. Squeeze. No, I really know what the squeeze is. So I haven't been trading in a long time. As a matter of fact, I turned my trading. I use TradeStation. I turned my trading platform off really just about 3 years ago, right around this time, thinking that you know what, I don't want to be distracted with the market. I'm going to be done in 3 months. And I'm still not done, and I haven't turned it back on. So I don't even watch the markets right now, anyway. Yeah, as a matter of just to tell you what, maybe I shouldn't say. I don't know. I'm gonna say it anyway. I'll give you an example of what I'm talking about. Where I'm at right now in the book is the last chapter, and I'm actually writing about subjective discretionary trading. It's taken me like 26, 27 days just to get the first 3 paragraphs. What's the name? I know you're gonna ask. I've got about 20 names. When I'm done, I'll pick one. Okay. When the name comes, I write it down, and if I can find the file, because I haven't thought of the name in a long time, I'm going to have to find the file. There's like thousands of files. But anyway, it's like, and when I say I worked, it's not like I haven't been writing. I've got pages and pages and pages. It's just that the words have to come together in just the right way for people to really get it. And it's not till it resonates, it resonates with me that, yeah, okay, I've got the sequence of the words just right. And like I said, the 25, 26 days just to get 3 paragraphs. And if you had asked me a month ago, I'd have said, hey, I'm almost done with it. I'll be done in a few days. Man. And what really scares me is the next part is intuitive. Now, I've already got a lot of the stuff on intuitive written, so all I got to do is find it. But then again, no, seriously, I'm not kidding, because I've written it years ago. So, I'm going to have to find what I've written. I'll find it. I mean, it's not like it's lost, but, I don't want to get into it. Anyway, so where are we? Yeah, right. No, exactly. It's it's my own problems with the whole writing process that creates all the difficulty when you get right down to it. I never, because I didn't grow up to be with the aspiration of being a writer. Do you really, or an author, or have any idea what that was like? Or here I'm almost finished my 3rd book. Spent most of my adult life writing books, and I'm like, it's like I just wanted to be a professional hockey player. I'm not kidding you. I'm really not. I grew up in the 60s or in the 50s, because I'm 66 years old, so it's like I grew up in the 50s, and back then there were only 6 NHL teams, and there weren't any American hockey players in the NHL. There wasn't not one American hockey player in the NHL. So my chance of becoming a professional hockey player was 0. But all I'm saying is that my aspirations were to be a professional hockey player. That's what, and to be a writer, it's like, come on. I used to. This honestly got true. When I went to Michigan State, and the term would start, and I go into a class, and the professor said, we're going to have a term paper. Huh, I'm out. Go my advisor, drop the class. Writing, forget it. I avoided writing at all costs. Now I know why. My life purpose was to be devoted as a writer, and I was just avoiding what I was going to end up doing. I didn't. Why start it back? Why start it when I'm in my late teens and early 20s? I'm going to end up spending my whole life doing it. But anyway, go ahead. You know what? These are all personal, individual variables, and it could be anything. I mean, just even, is John here? John. Okay, we were talking last night, in the cocktail thing, and John brought up that he made a connection. You want the connection about being a hero?
So it was interesting last night. We were talking, and as I was going through this kind of it's always a lot of fun living, the disasters in your life. And
really, yeah. When you're on the other side of it, yeah.
And as I was talking about it, it was a period of time where consistently taking my early 20s, taking $10,000 and budgeted it up to 100 to 130. And I've talked about this before, right? In one smart way, right? Get to 130, I would take $30,000 and go buy some real estate. And then the logical explanation in my mind was, well, they'll take 10 and turn it into 100, so now I'm going to take 100 and turn it into 100. See? I mean, I was thinking logical. And the first time I did that, we like 6 weeks later, I was back to 10. I don't really know what happened. And then it's like, okay, so I, took it off. About a year and a half later, I was back up to 120, 130. Again, in one start thing, took that down back to 100, took that money for real estate, the down payment, 100 questions, stuff like that. And then I'm like, all right, so obviously the market got me at other times. So now, I took it from 10 to 100, and now, I was working and going to school. And, okay, so now I'm going to go from 100 to a million. And in my mind, this million was like a big thing. It's like, well, that's financial freedom. That's, I can quit my job. I can that's all I do. 6 weeks later, I'm back in it. It's like, man, the market got me again, right? And so the third time was the worst. Was the, at this point, it was like a good-sized trading account, about $30,000, $40,000. I was fully weekly income out of it. Had a job where I think like $50,000 a year. I could quit. My wife and I moved up at the time of the fiance. We moved up to Minnesota in January with the job transfer. It was 34-0. And she said, look, you're great, but we don't have food and stuff. The car was parked outside, but we don't get a garage, a house. And okay. So I found a house, $30,000 down payment, and I had to figure out my trading account to do it. And I really had this in my mind, but I was kind of like, I really like my trading account balance. I don't want to use it by $30,000. So I've had to do a couple of different trades. Made $30,000. And then when I pulled that thing out, my trading account balance did the same. Okay, so that was kind of the same idea. And so I did that, and it was like, this trade I didn't etch in my mind because I bought 148 puts at like $8, so $8,000. And this was like in 1995. Nice downtrend in the markets there. And then at one point the premium dropped toward the end of the day, and it came down to like $30. I was like, wow, I had life in the 8, I love the 7. So we had put the rest of the account in the 7. And remember, I was only trying to make $30,000, and then it closed. I was up like 7 or 8 times. Like, wow, you're going to look at that morning, I was doing nothing. So the next morning I wake up, I turn on the ABC, or a single apartment, and there was a green arrow, and 136 Dow points up. So, naturally I turned off the TV and should go to the world. Honestly, that's not a live shot. It's a live shot. And turned back on down 136 points. I'm like, okay. Now at this point, I've been trading long enough to know, like, okay, so this obviously is trading for work. When we come back down to half a gap fill, which is a high probability, I'm going to get out of our trade, I'm going to end up losing that trade. I'm like, let's learn. I would never ever do that again. But now I got to trade it sideways, but I've never seen such a sideways market. And at the end of the day, it was, wrong way. And the next morning it got up and rallied, the next morning it got up and rallied. And I've never blacked out in my life, but I don't remember that period of time after that. There were like 4 days. And I woke up suddenly and realized the next day was closing the house. I'm like, I have to sell it. My account. And I sold it, and my account was like $140,000. Remember, I paid $30,000 for the house. So, okay, so this is and at the time it was just very clear to me that, I did not go tell Maria what happened. So I maxed out my credit cards, got money, went to closing, the money account, everything was going fine, but at the last minute, the lady was checking my people and said, we said that you're going to put $30,000 out of your investment account, but it came from your checking account. We just need to see the buyer from your
jeez.
So at that point, I just decided that let's close it back. This is stupid. And I said, I don't want to do it. So we went back and forth for 30 minutes. I'm like, I don't understand what you're saying. Finally, I got frustrated. And somebody's like, I'll be glad that happened today.
Wow. Worse than I thought. But you know what I want you to get to, though? Was applying. Okay, yeah.
So after this, I'm having like a really hard time with this. I'm going like, I really want to do it, but I cannot do this. I need to find out what's going on. About this time, I came across this trader. And as I was reading it, I mean, it was just kind of like going, wow, this is what was really right for me. And what I realized out of it, and this is, over the course of looking over it, is that there was something naturally heroic in being able to survive that. And somehow I firmly believe that subconsciously creating situations where I can do it. And how heroic is it to lose every penny of capital that you have and still won't be able to buy a house? Right? No bullshit with that. And at the time, that obviously wasn't going through my mind at the time, but looking back at it. And it's another line, I mean, it's like one of those, okay, you kind of grow up, and everybody kind of has issues like, okay, parents divorce, okay, dad was good. The things that maybe I wish I could have done something to help out. And I was replaying that out of my trade. So, but once I realized that, it stopped happening. So that's one of those things where it's kind of hard to like, it's one of those things that hard, it's hard to point at and, yes, that's what happened, but I'm like, once I realized it stopped happening.
Yeah, thank you. That's exactly what I wanted. He was applying his own agenda. In other words, he had another agenda other than just being a successful trader. So that's why I couldn't answer your question about, what's happening with people because there's all kinds of agendas that we have. And when we trade in mechanical mode, it's at least a lot easier to be successful because we know exactly what we need to do, when we need to do it. Any deviation, we're making a trading error. In the discretionary mode, there's no such thing as a trading error because you can do anything you want. But then what you have is you have all these personal agendas that can really start to assert themselves. You can have personal agendas asserting themselves when you're in mechanical mode, but again, at least you know something is going on because I'm not executing properly. I want to make I'm about ready to do something that is defined explicitly as an error. And so at least if you got enough presence of mind to say, you know what, I'm going to step through that compulsive behavior and do what I need to do anyway, you'll be all right. But when you're in the discretionary mode, these agendas can assert themselves in a way that, unless you have a really high level of awareness, you don't even know what's going on. Making sense? Okay, that was the introduction. As a matter of fact, you know what? Before I get going again, why don't we take a 5-minute break, bathroom break? Is that all right? Everyone look again?